Good morning, good afternoon, welcome. This is really, first I want to congratulate the guys that put this together. They've done a great job, so let's just give them a round of applause. Show them, stop looking at your phone, I'm congratulating you. And this is really a great panel. In trying to prepare for this, I'm always on panels, but I usually don't get the chance to moderate. So I decided I want to change the format and hand them the questions. They ask me, I get to speak the full 45 minutes. But then my partner, Abe, said to me, Ralph, you can't do that. It's a great idea. But he let me at least share my vision of what this panel would look like. But I'm really excited about this because you're all clients, you're all friends, and you're all legends in the market. And I'd like to ask you each to introduce yourself. And also, in order to make this informative, I'd like to keep it moving. So if you go too long, I will cut you off.
Well, you're going to cut us off whether we go too long or not.
Correct.
Hi, I'm Jordan Sloan. I'm the chairman and CEO of Harbor Group International. You may know Harbor Group. We own apartments, office buildings, a little bit of retail here in the US, a little bit in Europe. We also buy debt and originate preferred equity as well as mezzanine loans.
Hi, Hi. Good morning. My name is Laurent Morali. I'm the president of Kushner Companies. We're based in New York City. We are a diversified family-owned business, and we have 5 main businesses: multifamily, commercial, development, lodging, and lending. Very happy to be here. Thank you.
Good morning. John Adams, New York Community Bank. I'm the Executive Vice President, Chief Credit Officer. For those of you who know New York Community Bank, which I'm sure most of you do, I hope you do, $52 billion in assets. Our primary goal is lending. That's where we make our money. We deal with all these fine folks here up in this panel. You know, Ralph and Meridian, good friends of the bank, and looking forward to an informative discussion this morning.
Hi, I'm Ken Pasternak. I actually had a 30-year career on Wall Street. Started in the real estate business about 10 years ago. Founded KABR Group. We basically are value-added, opportunistic, and merchant builders. And we're probably about 80% multifamily and 20% other, with the other being mainly office.
Thank you. So I'd like to ask Jordan and Laurent this question. Over the last 24 months, it's no secret to Meridian and to the industry, you both have taken down very large portfolios outside of the New York City market. I'd like to ask you what key markets have sparked your interest in 2019, if you can share with us on those very successful portfolios, and to this audience of a lot of young people, what guidance you can give them, how you looked at those deals. So it's a loaded question, but I think it will encompass a lot of it. So Jordan.
So I think the first thing is, one of the things we try to do is to look for markets that have higher growth rates, job growth rates than the national average. That's kind of where we start. Sometimes within a big portfolio, you end up with properties that are not above the national average, and we usually look, those are considered short-term holds for us. But that's the thing that we look for. And buying a big portfolio, by the way, there's a lot to it. There's obviously arranging the debt and there's arranging the equity. But I think one thing, and for this group, that's so important is making sure that you are ready to accept those properties on the day that you close. Because we all know, whether you bought 1 property, 10 properties, 20 properties at one time, getting out of the gate is very important, making sure you have the right staffing. And when we bought the Beacon portfolio 2 years ago, which was 25 properties, we closed on one day, took on approximately 250 new employees. That was probably the execution of that was as challenging as anything with that transaction.
Right. So I think we actually look at a lot of the same portfolios. Thing. So maybe I would add one twist, one angle to this is, right now we are in a very low interest rate environment, and we've seen that multifamily has been a very sought asset class because it's another way to generate yield, to generate what we call cash-on-cash yield. And this is really what we're seeing. There's a lot of investors from all around the globe who are looking for good yield in dollars. And really today, that's one of the few ways to get it.
I mean, I would recommend that the group here, they focus on a different asset class. It'll be a lot easier for us.
I'm not sure I agree with that recommendation, but that's. And just to add to what Jordan said, in a recent meeting when Jordan spoke to a lender, and he said that we have 90 people in the field working on this transaction. But the most impressive thing was, he said, we hired a consultant to help us guide us through this transition. And I said to myself, here's Harbor Group, one of the major players in the country, realizing that this transition is so important, and there are experts in every single field. And I think it was an impressive thing, and I've seen that in the Kushner companies over the years. Ken, I'd like to ask you a question. Can you tell us one anecdote? You have an amazing career path. You went in Wall Street, then you went into the private sector. Regarding your business experience you had that changed the way you do business or the way you approach the business differently from your Wall Street career to a private investor over the last 10 years?
Well, I think you say, why am I in real estate versus something else? Because I've been both a allocator to the stock market, if you want to look at it that way, an entrepreneur, created a financial services company, and now I'm in the real estate business. So about 20 years ago, I started to see technology and regulation ruin businesses. Sometimes that's called, somebody who has a destructive innovator. Amazon could be an example in retail. And I started to look at where my own expertise is, just understanding the flow of capital and building teams would be not immune, but well respected for those talents and not suspect to marginalization because of either regulation or technology, like trading was on Wall Street. Or some of you have seen, I never got into retail brokerage, but you saw that commissions went to zero, which is probably a price that sounds like a pretty tough business to me. If you think of rents going to zero, I would want to be a landlord. And I came up through about a 5-year analysis with real estate, and then I started to look at what happened after the crash, and I thought you could make, frankly, returns that historically were double what you made in Wall Street, which is about, let's say, between 6.5 and 10%, and most private equity real estate, we're targeting 14%. Just for the record, for the decade, we've achieved about a 21% IRR net to investors over a 10-year period. So my assessment was correct. But again, where you weren't disintermediated by technology, where capital was respected, where an operator got paid and you could make above stock market returns. And real estate's been really great to me across those methods. And my guess is most of you are here for the same reason.
Thank you. John, Chief Credit Officer at New York Community Bank. Meridian has had a close to 30-year relationship with the bank. My very good friend and client here, Danny Benedict, reminded me last night at one of the first deals in 1991. I brought an $8 million, he gave me a deal. I'm proud to say to the young people in this room, he reminded me I refused to leave his office till I had the deal signed up. Then I had to find a bank, went to New York Community Bank, and $8 million was a little bit too big for them. So we've seen the tremendous growth in the bank. I always admire the credit standards of the bank and your committee and your CEO, all about the people they lend to. Real estate is great, it's got to perform, but it's all the people. So you've done an absolute phenomenal job, $52 billion bank. But we all know that New York Community Bank is primarily a New York City lender. They've done a lot of business, followed the Kushners and the Jordans and the Kens all around the country. I was told this week that I'd like to try to expand that, but to say on this side of the Mississippi, I actually said I have no idea what the Mississippi is, and Jordan knows I have no idea when it comes to that. And I said we now have a new task in Meridian. We're going to move the Mississippi. So we're going to work on that. But why don't you share with us some of your change of your underwriting criteria through the rent guidelines and just the vision of a banker sitting in your committee and getting pushed by a competitive market. You've kept disciplines, but you've also done a great job. So it's a loaded question, but I think everyone would love to hear what a banker's perspective is.
Absolutely. And just to be clear, you still don't leave our office until you have the deal signed.
I missed that. I'm sorry. What did you say?
I said you still don't leave the office until the deal is signed up. So some things just have not changed. As far as how we handling the underwriting for the new rent laws. Obviously, we are, I think we still are, the largest portfolio lender for rent-regulated properties within the city. So we have a fair amount of exposure to New York City properties that are governed by rent regulation. But the good thing is with us, which I'm sure many of our lender friends out there who lend in that market, we underwrite on the in-place cash flow. So we really don't see an issue on a go-forward basis in the portfolio, because when we underwrote the deal at that time, the income was there. We weren't banking on vacancy, decontrol, and pumping the rents. We were to the point where maybe that property would refinance in a few years, and they pull some more money out, we get some penalty, and we get a chance to resize the deal. But today, since June 15th, 20th, whenever the rent regulation rules changed, the only real difference that we're doing with our underwriting, and for those of you who have to deal with the regulators of the world, everything is about stress and what ifs. So we've been, for the past few years now, every time a deal comes in, we had to come up with a model on how a certain property would react to a jump in interest rate, a jump in cap rate. And we got to a point where they were comfortable with our analysis and how we funnel it through. But one thing we gave added benefit to when we stressed the interest rate, that on a rent-regulated property, we would allow that coverage in our minds at that point in time to go below a 1.0 coverage. Since the rent law has changed, we only bumped that back up to a 1.0. It was like two.
And just to be clear, you've added 200 basis points to your current rent and stressing that on
So
a
the
30-year
stress rate,
amortization.
the stress is, so let's say you're closing today at a 3.5 rate, which rates are going up, so I don't know if that 3.5 may not be here tomorrow. We would
Guys,
stress
3.5 is still there if you need it. I'll be seeing you outside if you need to sign up your deals.
So we'd stress it at 5.5, and at that 3.5, we'd look to have a 120 coverage. So stressed at 5.5, if it was rent regulated, we would say, okay, maybe just under 1, a 0.975 would be acceptable, knowing that the rent roll was going to be lifted just by normal vacancy and maybe a buyout. It's all gone. So now what we've said is we're not going to be as aggressive, but we'll bring it down to a 1. I mean, rents will go up, just at a much slower pace, but other than that, we really have not reacted dramatically different to our underwriting when it comes to the rent changes that we've all in this room probably are dealing with at some point.
Thank you. I think that was very informative. So the last panel, which I found was really informative, some highly intellectual people, attorneys that are addressing all the rent regulation. And it was touched upon, but I'd like to ask, Laurent, Jordan, Ken, how do you look at this wave that has now covered New York, touched California in a certain way? Do you fear this thing going across the country? How are you addressing it? And how would you advise people that are looking at real estate to deal with that?
I think I agree. The panel before was super informative, but they said it very clearly that they clearly think that it's going to expand to other states and jurisdictions, and I agree 100%. I was talking to one of my colleagues when he heard this, and he said this reminds me of when you were at the CMSA or CREFC conference in 2008. The mood was not too optimistic. So for this particular asset class, I think it's worrisome, but like everything else, there's going to be a repricing. They started talking about some new transactions, but the volumes are way down. So I think it's going to take more trade to see really where the market is, and I believe we're going to see this in 2020 actually, and I think we're going to see some deals happen in 2020, and then it's just going to be repriced. And yes, I think it's going to expand. And again, I was following the ... of what they were saying earlier, that it's going to go all the way to the Supreme Court. And I hope they're right that at the end we win. But even if they're right, it's going to take years and years and years and years. So you have to have a very long-term horizon if you're going to buy right now, I think, for this type of apartments.
Thank you.
I mean, I agree with Laurent that you should plan that these laws are going to spread. But I think you have, and I have to confess, I missed the previous conference. I had a call I had to do. But I think you have two types of rent control. I mean, what's happened in New York seems to me to be really, really punitive. California's is more benign. It's not as bad. And I think that wherever it is in the United States, one should think about it and plan for worst case scenario. I'm not saying that the rent regulation is going to be like New York, God forbid, that should spread. But I think some type of rent regulation could go to a lot of other cities. As you know, we're actually acquiring another very, very large portfolio, not in the same markets as the first deal, which was in the Northeast. These are more in the Southwest and Sun Belt markets. And in meeting with various institutional investors, I was actually surprised. That was like the first question that everybody asked. And I was really surprised about that. It wasn't about what kind of financing, what are your assumptions on rent growth, expenses. The first question was, are these markets, is there rent control in these markets, rent restrictions, are you planning for that? So I think it's something that we all have to be ready for.
So I ask this question a lot, and I get answers, red states, blue states. I mean, do you think that will dictate a lot? Or is it, someone said to me, it's also growth states. If you look at really big growth states that need to have supply and demand, you won't feel it as much. And I'm just curious, which regions and cities show the strongest fundamentals in 2020, and Ken, have you a view?
Well, maybe just through luck, we actually have about half our assets in Jacksonville, which you don't even hear anything about rent control. So we're shifting a lot of our efforts over there. But I think, to get to Ralph's question, I think you could put it in a matrix. It's portfolio management, it's a risk-adjusted returns dilemma. You're going to look at it differently, and if you're paid, I think, to the other two gentlemen's commentary, if you're paid for your risk with price, you may go into a already regulated market and just work through the issues because you think you're getting paid on a price basis. Or you may, which is what I would do, is I would go into marketplaces that had other characteristics like inward migration, but less likelihood, if not even highly unlikely, rent-controlled possibilities. And I'll give you an example. So I'd rather go to Texas, Arizona, and Florida than Washington, Virginia, and New York City.
Thank you.
Unless I'm paid for it with an unbelievable basis. But those are all choices that we'll make, and 10 years later, you'll see how it works out for you.
But the Kushner companies and yourself have been active in Jersey City in those markets. That was a big benefit because of the tight market in New York City. Do you see that changing at all? Laurent, how do you see that Jersey City market? I know it wasn't a question we spoke about before, but I think it's just a follow-up question if you can answer us.
The Jersey City market, we see it, I've been, I think, one of the first few to call this the sixth borough of New York City, because that's really what it is, except it's not, you don't pay New York City tax. It's a bedtime community for New York City, and we're very focused on affordability. And it's a simple math, right? So you go there and you look at the rents that are paid on the rental buildings, and they're about 50% of what they are in Manhattan, and they're about, they used to be half of what they were in Brooklyn. Now they're probably 2/3 of what they are in Brooklyn because the market went up a lot. So we look at it as an affordable place, in the New York metro area with a lot of growth. But then again, the politics is starting to have a big role over there. So.
Thank you. So I'd like to switch a little bit. Everyone's being very polite. Everyone's agreeing. So.
Oh, can I add one thing
Sure,
to
please.
the conversation? I'm sorry, but the other, I thought it was very interesting in Minnesota. and I don't remember, is it the whole state of Minnesota or just Minneapolis, where they have, I believe, they're not allowing single-family housing. Everything has to be multi-dwelling. So there's other types of ways the municipalities are also stepping in to encourage new construction, which we do have a housing issue in this country.
And is Minnesota on which side of the Mississippi? So I'd like to speak a little bit about, which I think is really interesting to the audience, and all of you participate in this in a very big way. We at Meridian have had many discussions with our clients on the equity raise, whether it's institutional equity, private families, insurance companies. I'd like to hear just a broad discussion about when you look for equity. You've all done a really good job in raising patient equity, but how would you advise young entrepreneurs that are going into the market, looking at deals, and they need to raise equity? What's the best approach for it, besides for hiring us, but just a long-term look?
I'd like to tackle that, if
Please.
you don't mind. I think the biggest mistake that young people getting into this business make is overpromising. And I really encourage everybody to make your projections conservative, realistic. If you can over-deliver, under-promise, and over-deliver. Nobody will not do business with you because you delivered a 12% IRR. But too many times, I once spoke at a conference, and this is a true story. Somebody came up to me and they basically told me, and they didn't say it in a what's the word I'm looking for, like in any type of criminal way, but they said that they have to show 15%, 16% IRRs, 17% IRRs, and I said, well, we haven't been able to find the types of deals that we buy that we can achieve those types of IRRs, and he said, we haven't either, but if we don't show that, we won't be able to raise the money. And it's just, I think it's so important.
I agree. I think the truth is you have to forge relationships, and long-term relationships. They're based on what? On being genuine, on being honest, and mistakes happen, and sometimes a deal doesn't go as well as you planned. And I think your partners will appreciate someone who acknowledges what the problem is and who is focused on finding a solution. Versus ignoring it and pretending everything is great. Oh, and by the way, let's look at the next deal. So I think it's a long-term exercise, which I know young people don't like to hear. But that's what it is. You have to forge relationships, friendships, and by the way, at the end of the day, the reason why I love doing what I do is because you end up working with people you love working with. And that I think is, when you're at that point, I think I think you've made it. Like you're a successful entrepreneur.
Very well. So Ken,
I might have a couple things. We just started reporting it to Preqin. You might to go into Jordan's comment. The average fund in the last 10 years promises 14 and delivers 9. So you could see how the disconnect. But interestingly, 9 is the 75th percentile. So I think if you get to in your pitch. If you talk about what's happening in that's the 600 largest, real estate funds in the United States, about what you really can achieve, you get realistic about, when you're getting into 15 or 20% returns, the risks you have to take, particularly for new guys, the chances that you'll be successful are probably unnecessary risk for yourself. And you probably won't achieve it, so you'll be a kind of a flame out. And the second, just to give you some perspective after being in the business for 10 years, if you underpromise and overdeliver, almost all of our investors are programmatic with us, and we're oversubscribed every time. And I wouldn't say we don't have to market, because you always have to market. Yeah, a wise man once told me, if the monkey don't dance, the monkey don't get peanuts. So remember that one. But the reality is, if you're under-promising, over-delivering, I think you'll have a virtuous cycle for yourself on the capital
I
side.
would like to add one thing, which is ironic, but the second deal sometimes is the toughest one. Why? Because if you do a first deal that goes well, your investors are going to say, great, let's do another one. And that's where you have to be really strong about the expectations, because there's a temptation of doing the deal, but you have to be really strong and stick to the facts.
And if I might add, just from the lending perspective on that, though we're not raising the capital, but we are very curious where your equity and capital is coming from. So with your organizational structures, the simpler the better. But if you have preferred equity, and that's how you're raising some of your capital, keep in mind we do factor that in on if it's an accrue, or is it a monthly pay, or does it accrue? Because at some point the investor is going to want to get paid, and it's going to be coming from cash flow. We factor all that in, so you have to be realistic in what you expect to be able to return to your investors.
My advertisement is, though, if you have a Harbor Group or a Kushner as your preferred equity partner, they add value to the deal. They help
100%.
coach the sponsor along the way. In some
Agreed.
cases, able to save
All I know.
save money on insurance, save money. I think they add value.
I think these are all really good points. When I started my career, I remember reading an article that the CEO of Tiffany said, if every day I have to open my doors and look for new customers, I can never sustain my business. It needed 70% repeat customers and 30% new business. We track that at Meridian, but what I've seen a lot, and a lot of the investors in a lot of your deals are repeat investors. They were there in the first deal, they were in the 10th deal. One young guy said to me yesterday about a guy who put in his first $1 million. It's now been multiple deals later, and he's made $8 million. And I think that is exactly Jordan's point. I have that, Meridian has 400 people today. We have a training program. The biggest challenge we have is always don't overpromise your clients, because ultimately you will lose the client for that. And I think it's such an important lesson. And, Ken, you said before about real estate. Someone said to me last night, I don't know how I missed this article, that there was an article in the Wall Street Journal recently that the most wealth that was created was through real estate. I did not see that article. I don't know if anyone saw that. But, we all talk about the tech and everything else, but real estate is just such a good, solid, fundamental asset class, and I'm proud to be such a big part of it, and I think everyone here is done well. We all know that one of the things that has covered up for some mistakes is interest rates. It's a touchy situation. We get all the time questions. I'm actually personally have a view that I'd like to share afterwards. But John, as a banker, you have a certain view, and Jordan and Laurent and Ken, as an investor, you have a different view on interest rates. How would you advise some of the people in the audience how they look at interest rates and how they should be thinking about it?
Well, rates are going up, so lock your checks in, give them to Ralph, and let's get the deals done. I think this is a big year coming up because it's an election year, so I don't think we're going to see anything too dramatic from what we're hearing out there. I mean, the 10-year today is a Friday. I don't think the market's open. It's about 194, 195. 2 weeks ago it was 163. So it's all over the board. I mean, 25 bips one way or the other. But I think the environment that we're seeing right now is going to stay pretty much where it's at. I don't think we're going to be seeing rates a lot higher, maybe 50 bips higher at some point. But I think over the next 12 months, it's going to be kind of status quo. We're going to see a little bit. I mean, we have an internal sheet that gets posted with the interest rates, and just to use as a guide. And for the past couple of months, I think every 2 weeks we were changing the rate. It was going up, it was going down. So I think that's the market we're going to see right now. So I don't think there should be any real concern that, if I don't do the deal now, the rates are going to be 200 basis points higher a year from now. We don't see that happening. We hope it doesn't happen. We have loans that are going to be coming due and repricing within the portfolio that, quite frankly, if it was a rent-regulated property that we underwrote at a 120, 150, 200 basis point jump in rate, that'll be a difficult time to refinance that out. So we don't see that happening, but I can see, like I said, maybe upwards of 50, but then we're probably going to come back down a little bit. So we're not panicking. I don't think anyone in this room should panic.
Jordan.
I mean, you got to witness firsthand with me last week on $630 million of debt. As soon as we could lock the rate, we did. At that time, the 10-year Treasury was at 1.77. It was a week ago?
Monday, correct.
Right, a week ago. And by the end of the week, as you mentioned, it was at 1.95. I have a rule that if the deal works and you lock that rate as soon as you can, don't get greedy, just lock the rate. If it goes lower, okay, you'll take advantage of it on the next deal. But don't mess around. I mean, Ralph knows I was literally screaming at the top of my voice, we have to lock now.
Yeah.
And thank God we did, because it would have cost us literally on $630 million over 10, it was a 10-year money. It would cost us millions of dollars.
I agree. I mean, usually, by the way, every time I do a rate lock, you can bet that the following day rates go down. So next time I do it, I will put something on the real deal so you can all bet on it. But or on eCore's website, really. I agree. I mean, I think we are in the real estate business. We're not in a hedge fund interest rate hedging business. So I think that if the rate is good for you, you lock. If you buy multifamily with a long-term view, you must rate lock for sure. And so anyway, it's always a fun exercise, sometimes stressful. I'm looking at Abe, but it's all good.
You know, I might have a different approach, more of a capital markets approach, might be instructive. The last 10 years, we have about, right now, the effective interest rate's about 200 basis points lower than the 30-year trailing average on what you'd pay. So I can remember 15 years ago when I started looking at real estate, and I pay 5.5%. I thought that was a steal of a deal. So getting back to the asset class and what Ralph said is about the wealth creation, there's two very major things that have occurred this decade that are highly unlikely to occur the next decade, and I won't give you a whole dissertation on it, but a lot of the cap rate compression occurred for two major reasons. The first reason is this interest rate. You're 200 basis points lower. There's about a 0.4 to 0.5 correlation in cap rates to interest rates, by the way. You could study it back 50 years. There's a couple of Harvard studies that will substantiate that. And the second, as you all know, a few of you probably played the stock market, and stocks trade at a P that's related to, it's called the PEG ratio, to their growth rate. And we've had a golden era here where homeownership for the first time in my adult life has decreased from about 68% 10 years ago to about 64% today. And people have chosen for a variety of reasons, flexibility, they can't get the down payment, heck, who wants to own stuff if you don't think it's going to appreciate? For whatever reason, it's been a golden age, particularly of Class B and Class A apartment rent appreciation. So again, if you go back, you have appreciation, which causes high NOI growth, which causes a high PE expressed in cap rates. And I think the next 10 years, one of the biggest dangers are an assumption that both interest rates are going to stay low and you're not going to have a mean regression that we talked about that John very, with a lot of conviction, predicts happening. I'm not against it, but I would just say that when you're promising a return and you're modeling a building, you, particularly if you think you're going to add value and in 5 years refinance, have a refinance at cash out or cash regain, you might stress test, do some of the work that banks do where they look at 5% lending rates and 2 or 3% rent growth, not 3 to 5% rent growth. When you put that out on a model, you're going to have a humongous difference in both your terminal value and your NOI. Sorry to be so long-winded.
Just want to add one more thing real quick. One thing that I think is the good news, and I also agree with what John said too, and what Ken just said about stressing the deal. But when I was starting in the business, outside of New York, which is where Harbor Group started outside of New York, Class A deals, Class A, we're trading at 7.5 to 8, I would say closer to 8 caps, and Class B deals were 9.5 caps. But the good news is that back then, real estate, particularly for institutional investors, was kind of the ugly duckling. They had an allocation of maybe 3-4% to real estate, and that was it. Today, institutional investors are allocating a lot more. They see the importance of having, so the real estate asset class has moved up a lot in the world. So I do think you should plan on increased interest rates, increased cap rates, but I don't know that we're going back anytime soon to Class A deals trading at 8 caps and interest rates, as John said, going up to, the 10-year Treasury going up to 5.
I think all of this really has to do with interest rates being at 0 or close to 0 in the rest of the world, okay? So now, if you are an asset allocator and you're based in London and you're looking for yield, how do you get yield on in your portfolio today?
Yep.
Okay, you're not buying the 10-year German Bund at 0%. So you buy US real estate unencumbered, right? So that's why you see all these cap rates also go down, go down, go down. And I think it's going to stay like this for a while. And they price this, it's like bond pricing, right? So exactly. If interest rates go up, then obviously the value of the...
Everything has become a global market.
It's a global market. So you have to think like this, yeah.
I think this was really informative. I had a lot more questions, but I think that at this point we should just open this up to some questions. I just want to thank all the panelists, but I just want to say the common theme amongst all of you, you've built great businesses over a long period of time, took no shortcuts, and have really, truly been true to your word in so many ways. So from the Meridian and from a personal, I'm honored to consider you clients, friends, partners, and I think to the young audience here, to anyone in the audience, you always need to have somebody you want to look up to and emulate. And every single person on this panel and many of this in the room, I really think this conference has just been terrific so far. And if anyone would like to have any questions, we have a few moments left. Just direct the questions to whoever it is and feel free.
First off, I'd like to say thank you very much to Meridian and to New York Community. I would like to say that with New York Community, I remember when we first started with you, the questions that were composed to us were at the beginning were very challenging. Afterwards, they were really great, truly appreciated all of the input, because the people that were on your board are people that are knowledgeable of what they're doing. So when they say what they're saying, they're giving you phenomenal advice, and we've actually used that to our great advantage. So thank you very much.
Thank you.
Also, Jordan, I'd like to say thank you to you. There have been, pardon me? I just wanted to say that you, as far as what you're saying, as far as keeping being honest up front is phenomenal, and it's been helping people a tremendous amount of what you're doing. My question to you is, I've dealt with people who are doing investing in our area. They ask us for advice on whether an asset is worthwhile. We explain to them with the real estate uptick and the taxes and what have you. It turns out that we strongly suggest that it's not going to be worthwhile, and yet somebody else comes and outbids them by a considerable amount. So my question to you is, how do you combat that? How do you go out and find deals in areas that seems to be such a tough issue?
I'll tell you, I'm so glad you mentioned the word taxes, because I know that we will all agree, all of us up here, that is the #1 issue for underwriting deals today. And I'll tell you, as the municipalities get stretched, I think it's going to become more difficult, but it's very difficult. We use consultants, and in a lot of cases when we're working on very large deals, we use more than one consultant to get different opinions. And then after we get the number, we usually try to err on the conservative side, but that's very tough.
I agree. We've killed more deals because of in underwriting because of real estate taxes than ever.
Yeah, and there's one thing when we're underwriting a deal when it comes to taxes. Income growth, especially now in the state of New York with the rent regulations, not so much growth. Taxes, are going to go up. So what we've done when we look at a deal and we size it, if taxes, are here today, they're going to be here tomorrow. We get pushback when we underwrite it that we should look at it here, but 2-3 years from now, it's going to be here, and you're just going to end up hurting yourself if you don't bake that in, as the bank does, because I know that they want every dollar, but if you don't forecast a certain ratio to income or expenses as your portion of taxes, in the long run, it's just going to end up biting you.
John, are we going to keep the dividend on the New York Community Bank stock?
Absolutely.
Okay, great.
Absolutely.
Jordan, I'm sure you encounter, like we do, very often being bid out on deals anywhere and everywhere, and we don't understand the numbers that are being communicated to us by the brokers, and we say, how is these guys paying that much money? And I guess my question to you, and maybe for the entire audience, would be, what's the next frontier? Where do you see yourself going in a new markets or something where there is room to actually create some more wealth and some more value?
I mean, that's a tough one, Danny. I mean, for us, it's been to start focusing on some of the Western markets. Harbor Group, which is 35 years old, up until 5 years ago, we were just focused on the East and the Southwest. Now we're looking into, and we've been active on the West Coast. There's some really good markets there. Phoenix happens to be one of them that we love. And I mean, but it's not, we're not the only ones. So that we're not an innovator, but just for our company, that's something that we did not have exposure to. And for our company and our investors, one of the things that we're trying to do is have diversification, give exposure. I think we've mentioned before, the investors, and we have a lot of overseas investors, they're looking at things on a global level. And just to say, you know, you're only in New York, or you're only in Washington, D.C., or you're only in Florida, doesn't necessarily do it for the institutional investors. So you know, it's very hard today. I mean, a few years ago, we had a strategy to try to buy brand new deals that were still in lease up. That trade went away. Of course, value added is the, you know, I laugh because you get in a 2017 deal and it's got value added printed on the cover. I'm not sure how you add value to a brand new deal, but so
It means value to the guy who's selling it.
that's. I don't know. What do you think, Laurent?
I agree. Diversification for us, we've been investing a lot in Florida lately. No regulations, so refreshing. And the East Coast, we've been looking at other markets. Yeah, you just have to be diversified.
Just one other thing I'll just add is a little bit of the flip side of your question, which is we're in a mode now, not so much to focus on how much we can make, but to try to avoid losing. So the things that we're doing these days are assets, whether it's multifamily or office, that we feel lower risk. We'll take the lower returns, but we'd rather take lower risk.
About 3-4 years ago, we started looking into multifamily. We're single family guys that we aggregated, you know, about 800 single families. And the reason we went to multifamily is because that is just so much more convenient. But we started talking to investors, and some of our investors were distracted with hotels and office. And I started thinking to myself about, you know, how is technology going to affect all these asset classes, and started researching into that and actually writing a book about the effects of technology in real estate. And as much as I want to believe that, you know, multifamily is going up because we have European capital chasing that yield, I think that there is a subconscious decision that a lot of people are looking at multifamily and saying, you know what, this is not commercial, it's not going to have the Amazon effect or the Uber effect or any of the effects that, you know, we can sit down here. And basically it's a basic need. It's not going to change, right? And I think that that's a risk that a lot of people are not really considering up front, but it's subconscious in a lot of the investors that we've seen right now. So has anybody really considered that effect into your underwriting?
Well, I think I told you that I actually came from a business that was disintermediated into real estate because I knew it couldn't be if you want to use a destructive technology, couldn't destroy it like Uber's destroyed cab drivers or whatever you might say. So I do think there's interesting, I think people at a subconscious level, they're not so much consciously going into it as much as exiting businesses where they think there's very much marginalization and a race to zero. Like if you were going to own brokerage stocks and they're all going to zero commissions, how do you make money owning them? And moving, and then they're looking at their alternatives and they're finding increasingly real estate on a risk-adjusted basis of being attractive and immune to that destructive technology. So I think there's, again, it is occurring as more of a misunderstood force. So you are kind of right.
And basically, that's the point. I think that regardless of whether their interest rate is high or low, a lot of people are going to gravitate towards multifamily as a least
Yeah, well, going
risk.
back to what you said, there's a couple of forces I think that are happening. One is that the institutional appetite for this asset class is, you heard about 35 years ago where it wasn't really an institutional asset class. Secondly, that there's a whole bunch of people that look at it like an inflation adjusted tip. And thirdly, they look at it as protective against technology disintermediation. So that's why we're not probably going to go to a 9% cap rate, because we have all those three forces.
I know that Steve wants me to add one point, which is that right now there is a huge trend, which could be a disruptor, we'll see, in the multifamily, which is the short-term rental business. And it's exploding in urban areas, okay, not garden style. I haven't seen it in garden style, at least suburban. But in cities, it's exploding, right? And we saw this with office, obviously, with the WeWorks of the world. And now you have this happening. And it's going to be interesting to see what happens there. I think, as far as I'm concerned, as a landlord, I look at it because I want to know what's happening. But you have to be convinced by the credit of that tenant, obviously. And but it's very tempting for a lot of people to make that bet because they think they don't have to worry about anything. That's true until that tenant has credit problems.
So I'd like to wrap up. I'd like to just ask everyone just to give us 30 seconds of closing. What no one shared with you is how you heard Jordan talk about consultants. Just a little bit self-serving. As Meridian, we're really proud that you're all clients, and many of you in the room. And it just demonstrates how intermediaries add so much value. So I want to thank you for that and ask each one of you to just say a closing remark to the conference.
So I'd like to wrap by asking how many people in the room saw, there was a movie years ago with Rodney Dangerfield called Back to School, where he went back to college with his son. So he's standing in line to buy school supplies for the college, and the line is as long as it can be. And so he gets his chauffeur. He's actually a billionaire, so he comes there with a chauffeur. He gets his chauffeur to hold up a sign outside the limousine that says Bruce Springsteen. And all the college kids go running out of the office supply place to go see Bruce Springsteen, and he's now the first guy in line to buy the school supplies. So I just want to say that I talked to everybody up on this panel ahead of time this morning, and all of us decided we're focusing on self-storage right now. So I would recommend getting out of multifamily and focus on self-storage.
Love it. Rent control apartments are not bad either. So. No, all kidding aside, I think my view on this is it's a huge country. It's a great country. There's a lot of opportunities. There's a lot of growth. Let's not be too narrow-minded because a lot of us in this room come from New York City and we feel the pain and we talk about it every day. But don't forget, it's a huge country. There's a lot of opportunities. There's a lot of very strong markets with very strong fundamentals. And where I don't think the threat of regulation is the same as the other states or urban areas we talked about earlier. I don't personally, all this recession talk and everything, I don't buy it. I think that the economy is as strong as it's been, and I think it's going to stay like this for a while. So let's be optimistic a little bit.
Thank you.
I think that we need to stay ahead of the curve. I think we need to listen to a lot of the millennials and what they like with the live, work, play. But then on the other side, you got to look at the baby boomers. Baby boomers are now living longer. They're living healthier. They're not retiring as soon. So I think we all need to just keep in mind that the real estate landscape is changing, and we're going to have to think of ways to fill those certain needs that are coming down the pike. And as lenders, we're basically a bread and butter lender, multifamily, office, retail. But we're going to have to also start to be more innovative on how we look at deals and what the future holds. And it's going to change, I think, quicker than we think. I was reading an article where Gen Z and the millennials are going to have a crash. The Gen Zs are going to be moving into the the urban cities, and the millennials aren't leaving. They're supposed to go out and buy a home and raise a family.
And they all use self-storage.
And
And Meridian will now have a self-storage division starting this afternoon.
We just need to stay, in tune to what's going on out there. We need to be innovative and find different ways that we can all make money together.
I'll just leave you with a couple thoughts.
One thought, Ken.
I'm going to stay at under 60, most of the 60 seconds here. That I came into the stock market in the 70s when it traded 10 million shares a day. Today it trades 10 billion shares a day. And I watched a whole asset class grow up. And I watched this asset class in the last 15 years grow up. And it's very seldom do you have an opportunity to where you're involved in I think, the largest asset class in the world, real estate. And one of the common themes here is almost everybody here is passionate about the business and where you can, your avocation and your vocation are the same thing. So keep on trucking and stay dedicated. This is going to be a good place to be for the next 20 years.
Thank you so much, everyone. Great event.